Following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And we are on The Answer About Money. We're talking about money today, once again. So we've got a lot of things to cover today. It's going to be a program about big ideas. Very often, you see experts who have a very big idea, and they stick with the big idea for years or decades. And I've done that. But I want to talk about big ideas today, not just mine, but our new head of the Economic Council of Advisors, Larry Kudlow, because he also has some big ideas. I want to talk about those. It's big ideas. You know, since 2012, I've been talking about the supercycle, and that's a very big idea. We're now 7 years into that, and I've been talking about that every 3 months or 4 months, whatever it's been, time and time again, about that as being what's underlying this whole time of this secular bull market. I'm going to be talking about that because there are times when you have to question big ideas. Is it still valid? I'm going to talk about that in the program. I've got a guest today who's going to give you some insight into security. Very interesting program. We've got very great insights to talk about. And I will talk about Mr. Kudlow, who is going to be the chief economic advisor, as far as we can tell, to President Trump. But I want to talk first about this whole big idea, because I believe that history doesn't repeat, but that it rhymes. There's things that you can learn from history, and you get insights which help you move forward. I started talking about the supercycle in February of 2012. The Dow had reached 12,863, actually, on the day that I talked about the supercycle for the first time. Standard Chartered Bank of the UK, large bank out of the UK, had done a study, and they found a period of time looking at the world when GDP grew faster than average. They weren't just one time. They weren't just 1 year, 1 month, 1 quarter. It was over decades. And as I read that report, and as I began to understand what went into it, I took that as a big idea. Wasn't mine to begin with. It was Standard Chartered Bank of the UK. And I wasn't the only one. Almost, probably 50% of the people that I follow were also subscribed to that supercycle idea. They glommed onto it. Very, very few today talk about the supercycle anymore because they've kind of forgotten it. But I'm telling you, it's the big idea. And for me, what underlies this secular bull market we're going through. What Standard Chartered Bank said is that there have been 2 other times in which world GDP grew at a faster rate than average. And maybe there were more before that. But in their study, they identified 2 previous times. One was from 1870 to 1913, for a period of 43 years when the world GDP grew at a faster rate than average. You know, during that time, if you look at what happened, we went through financial crisis. It began in 1874, and every other year was a recessionary year. We were an agricultural country coming into that period of time. But because of going through those financial crises, it was a difficult time in many respects, but we began to shift from an agricultural nation to an industrial nation. And that supercycle was driven primarily by the fact that the U.S. became an industrial nation. That's what drove world growth, is our becoming an industrial nation. We drove that in the entire world. That had an impact. We didn't have just globalization starting in the last couple decades. We had a global impact going back to the 1870s. And I'm going to talk about what happened, why that happened as well. But that was the first supercycle. We emerged during that time as a world leader. Prior to the 1870s, the United States was this place a long way across the ocean, but it was the European nations which were the financial centers, were the economic powers of the world. And in the Far East, you had China, and you had those dynasties that were growing in China. But the United States was separated on both sides by oceans from the economic centers of the world. As we came out of that time of the first supercycle, the United States had emerged as a world leader, a position we hold today. So the second supercycle, once we got to 1913, things slowed down, GDP averaged out, and we had a growth period. But it was not extraordinary. 1945 to 1970 was the second supercycle, a period of 35 years in which it was driven primarily by the rebuilding of Europe. World War II had come to an end. A lot of Europe had been destroyed in the war. There was that to rebuild. The industries, the housing, the infrastructure all had to be rebuilt because of the destruction of World War II. And it wasn't just there, it was in Asia as well. But primarily, it was Europe. And it was during that time that there was the decolonization. From the 1600s until 1945, those countries in Europe had colonized the world. That colonized Africa, that colonized Asia, that made colonies, South America, a number of colonies in South America. If you look at the languages they speak in South America, Brazil speaks Portuguese. You saw the Portugal having a colony there. You had all that going on. But during that period of time, 1945 to 1970, those countries became independent. Those colonies became independent. But it was the rebuilding of Europe that drove that second supercycle. And then from 1970s, we've had a very good time from the 1970s to this period of time, but the world GDP didn't take off and grow. But it has. Since 2009, we've entered a new supercycle. That was the conclusion of the Standard Chartered Bank study, and it's one to which I subscribe. It's one that makes sense. It's a very big idea, and you have to examine that idea in terms of what's going on today. Last week I talked about trade wars, and trade wars can really upset something like a supercycle. Should we start to regress and go back to where we were in the early 1900s? We can go back to slowing down worldwide growth. So that's a big question mark overhanging this whole supercycle idea, because the third supercycle is being driven and going to continue to be driven, if it holds, by the emergence of developing nations. You know, those are the nations where poverty was huge. And we're seeing the emergence of those nations from subsistence levels into the middle class. Now, there's a big range of what you call middle class. You see it in this country. We have people that are a huge amount of middle class, and their salaries run from $30,000 or $40,000 up to several $100,000. Their net worths also vary. So it is in that time period that you have a big variance. But the estimates are that by 2030, 93% of the world's middle class will live in these emerging nations. They're moving from subsistence, where they raised their own food, where they grew their own or made their own clothes, grew their own food, to a time in which they begin to consume. They consume lattes, they buy cars, they buy TVs, they buy cell phones. We're seeing that happen. You know, there was a time, if you go back and look, when 94% of the world's population lived in poverty. That was our country as well. 94% of the world lived in poverty. We emerged from that, and we continued to emerge from the 1870s until the 1900s. We began to emerge from that time of poverty. You know, I happened to be in Boston. We went to see the John Adams house. John Adams used to make shoes. And those shoes that they were making at that time, when John Adams became president, when that happened, those shoes were made for either foot. There was no right or left foot. They were handmade, handcrafted, and they were the same size. They didn't have shoes that were 12 or 7 or widths that were A and B. Everybody got the same shoe. And you either filled the shoe up or it was tight on your foot. Either way, that was the way it was. They had porridge for it, and they had very little meat. They had no salads. They didn't have a lot of fruit. And longevity was like 45 years. That was a time in the 1800s as we moved into that first part of the supercycle. We're going to come back. We've got a lot of things to talk about. And I want to talk about the impact of recent events. So don't go away. I'll be right back.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So this is a program today talking about big ideas. My big ideas and some other people's big ideas. I started talking about the supercycle, a big idea I've been talking about since February of 2012, not 1912, 2012. And that underlies what this secular bull market is. But every time you have a big idea, when things begin to change, you have to examine whether there's going to be a change in the big idea. A lot of people become so convinced of their big idea, they ignore what's going on, even the obvious warning signs. So I want to be very sensitive to the fact that I have this big idea. I've been building client portfolios around it. We've done very well. But I also want to be sensitive when there's changes. And the change that happened last week with the tariffs on steel and aluminum, and this week they're talking about adding more tariffs to China for unfair trade practices. That has an impact. Free trade is economically very beneficial. We've been through other times when we didn't have free trade, and that has an impact on the economy. Without free trade, this whole idea of the supercycle could come crashing down, and we go back to a normal worldwide growth or even a slow worldwide growth. So last week I looked at tariffs and the impact that tariffs would have. So this week I want to talk somewhat about what's going on in terms of trade. You know, we're in the process of negotiating NAFTA. One of the things that the president said is he wants to use the tariffs as leverage to get NAFTA signed. I'm not sure that's going to happen. But we also saw the withdrawal from the Trans-Pacific Partnership, from TPP. Last week, 11 nations signed, essentially, what was TPP. Those nations, Japan, Vietnam, Brunei, Singapore, Malaysia, New Zealand, Canada, Mexico, Peru, Chile, and Australia, signed an agreement for free trade. That was years in the making to get to that point. But those countries will now be able to move materials back and forth without duties or with minimal duties. We withdrew from that, and that had an impact on some of the provisions because we were asking for 3 provisions that are no longer there in that pact. 3 provisions which kept China away from being part of that pact. 3 provisions which made China drop out of the negotiations. And those 3 conditions were related to worker conditions, they were related to environment, and intellectual property. All 3 of those. And those would have a very positive impact. In terms of the labor requirements, it meant that no longer could people do subsistence labor. That would have made U.S. labor more competitive. And we're becoming more competitive through automation anyway, but it would have meant we would be more competitive. The second thing was the environment. And those conditions, of course, we withdrew from the parent climate change. We're the only nation that did not sign into that, but we withdrew from that. But there were some environmental conditions based in the TPP as well. But probably the most alarming thing that dropped out of the new TPP is the restriction on intellectual property. I've talked a number of times about China, and they form partnerships with companies and then steal the technology. The newest tariffs that the president wants to institute on China have a lot to do with the fact that China steals intellectual property. You go there, they require Apple to manufacture some of their cell phones there, but that allows them to reverse engineer that and develop their own competing ones. China is requiring Boeing and Airbus to assemble planes there. That allows them to reverse engineer and build their own competing aircraft. All of that was part of TPP saying that the countries that signed that would respect intellectual property. Those were conditions China couldn't accept or wouldn't accept. The hope was that with those provisions and with that representing almost 30% of world trade, that China would have come along, because China has a significant amount of trade. They do more trade than we do, and we're second in the world. But that was the idea of TPP. We're now completely out of that, and those provisions are gone. That means if Boeing sells a plane to Vietnam, they can then take that apart, reverse engineer, and build their own planes. It means that Mexico and Chile can do the same thing, and those things will happen. One of the comments that came up this week is about Boeing, because with the new tariffs that were imposed on steel and aluminum, some of the focus shifted to what impact that would have on companies like Boeing, because Boeing has 80% of their sales going to the rest of the world. 1/4 of their sales went to China alone. 1/4 of all the sales that Boeing did last year went to China. 1/5 of their backlog goes to China. Think of what happens if China puts tariffs on or cancels all those orders. It can have a dramatic impact. So the question is, what does it do with the tariff and the trade with the U.S.? So far, the bilateral and multilateral agreements like TP are still being signed by the rest of the world. The U.S. is becoming a loner in this whole thing. While we say, and our president says, make America great again, it's also making America insulated again. We're moving away from the multilateral pacts like TPP, away from trade with Europe, away from trade with South America. We're becoming isolated. That's going to impact the U.S. There's no question. It will impact the U.S., and we'll probably see a significant tick in inflation. How significant? I don't know. But it's not, from the appearance now, we're not going to see a trade war with the rest of the countries of the world. The U.S. may stand alone. The U.S. may be in a trade war with a lot of countries. But it does not appear at this time that those countries are going to be in trade wars among themselves. you're going to have the 11 nations of the Pacific doing their own partnership, and China may well join those 11 nations and make it a 12th nation that has 40% of world trade. Those things seem to be happening. China's already been around the world talking to Peru. At the time we withdrew from TPP, China the next day was in Peru to talk to them about doing an agreement. You know, it appears that this whole idea of the supercycle is not going to be derailed by trade wars. The U.S. could be derailed by trade wars. So that's why during this last year, I've structured portfolios for my clients in the event that the U.S. is in a trade war with other countries that will very well come through it very well. But I don't expect that it's going to have a significant impact on the supercycle. The supercycle looks like it's going to continue intact and continue for the next 5, 10, 15 years. We're going to have to see. That means this bull market we're in, this secular bull market, should continue to roll on. Bull markets don't die of old age. Bull markets die of over-optimism, overconfidence, or a geopolitical situation like a global trade war. Don't expect that, but ever alert to it, nevertheless. Anyway, that wraps that up. I want to introduce my guest today. My guest is here, has a very interesting story to tell. Jake Stephen of Stephen Group International. Welcome to the program, Jake.
Well, welcome to me. Thank you very much. I'm humbled to be here. I'm very flattered, by the way.
So let's start with your background.
My background's really simple. I'm a Wazoo alum, so go Cougs. Basically raised here in the Pacific Northwest. After 9/11 and I graduated from college, I traveled around doing different security jobs and so forth, and I made my way back here and basically had various director of security positions throughout the Seattle-King County area, and then the Great Recession happened. And as that happened, the companies that were hiring me were going out of business, left and right. And so, as the American dream goes, I took my second to last unemployment check, and I applied for my business license, and 7 years later, here I am.
And you are in charge of Stephen?
Yes, Stephen Group International, sole proprietor, absolutely.
Sole proprietor?
Yes.
And you are in the security industry?
Absolutely, yes.
So tell us very briefly, we're coming to a commercial break, but very briefly, what that means.
What that means for Stephen Group International, our niche in the market is we take on clients in scenarios that other traditional security companies, uniformed patrol officers turn away due to the threat level and the hostile environments.
So you're small but nimble.
We are very small but nimble, yes, absolutely.
And take on some very key enrollments.
There are some very tough scenarios out there, and unfortunately, there's only so many police to help out the private sector and so forth, and we like to be able to fill that gap with our employees, which are predominantly ex-military or former law enforcement, absolutely. Unfortunately, with the climate of the city and so forth, with homeless issues and other economic problems, there's some hostility, and we like to be the go-between to make sure everyone walks away safely and de-escalate any sort of hostile environment.
We're going to come back and talk about that, especially after the kids marched this week. And we have seen a number of things that have happened. Don't go away. We'll be right back after the commercial break. Fascinating and interesting insight into what security is.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm here with Jake Stevens of Stephen International Group. Stephen Group International. Okay. A security firm. So tell us about the security industry.
It's funny. The security industry is a tough thing to define. The term itself lends itself to various meanings. There is a Webster's, definition, but depending on who you ask, it means something different. You can ask one individual and they immediately think of black-water contractors overseas in Iraq, and you can ask another individual and they think of the individual at the mall walking around in the uniform, parking lot attendants and so forth. And then there's that other one that sits at the elevator and points you to the fire extinguishers and so forth when you walk into a lobby. And so it's a very difficult industry to survive in. There's a numerous amount of competitors, and there's some initial challenges. One, you're not producing a product that's tangible as far as a material item. You're producing a person. And so right away, when it comes to recruiting and so forth, you're looking for an individual that's going to fit into your own company culture. The security industry is a multi-billion-dollar industry. The largest employer in the world is G4S. It's the largest security company in the world. I think the second highest employer in America is Walmart, just to give you an idea of the level of employees that are needed to fulfill those global contracts. And as someone who I would say is a proponent of the betterment of the security industry, it's hard to believe that G4S has, 20,000 tier 1 operators to help you eliminate any scenario. And that's been demonstrated because some of the more traditional negative connotations of security, such as like parking lot attendant and so forth, have actually been turned over to robots. Microsoft Campus has some. The Bellevue Square Mall has one. Scared me to death when I came around the corner. Right? But it did what it was supposed to do. It told me where I could park and what floors were full. So it's very, very disconcerting in my position as to how simple some security firms have allowed themselves to become. And that's where we step in, and our niche is different. We are that person that's there to help, to have customer interaction, to preserve the environment. We sometimes use the word security host, and as such, it's to be an invite into the environment and be that last wave goodbye as you leave. A lot of our clients like that about us. Our job is to preserve the environment, absolutely. But there's challenges. Again, I go back to company culture. There's a lot of people that come in our door that have years of security, but it's not our type of security. Or the companies are so large that don't have a company culture. You are literally just a person in the uniform with very high turnover. So in this market where we have Amazon and some of these larger employers that have just reduced the unemployment rate here in the state to a spectacular amount, it's very hard to find qualified personnel that are going to fit and protect your brand and develop your company independently. We don't have a website. Our business is based off of client referrals, and that is a compliment to the staff and their job out there and taking pride in the brand and the company and the brotherhood and so forth.
So when I see a lot of security people, and we live in a high rise, office wise,
right,
in a high rise. Our office is in a high rise.
Yep.
There's security people at the main desk, and if you lose your key, you call them. They come open the door. If there's mail to be delivered, sometimes they'll deliver mail. Sometimes they'll walk around the floor. It doesn't seem to be a very high-paying job, and it doesn't seem that there's a lot of qualifications for somebody like that. And yet, you're very different from that.
Yes, I don't disagree with anything you said. Unfortunately, the expectations of security have been so minimized that the individuals that come in to apply almost expect the job. And when you deal with clients, some of them have had contract security companies for years and so forth. And there's no magic words to make me sound or my company sound different. The proof is sort of what we call in the field. When we get there, you'll see the difference. It's in our uniform. It's the people that we hire. It's the low attrition rate. It's what we bill. Some people talk to me, how come you charge so much? Well, I charge more because I pay more. We try to stay at the top end of the market to get that recruiting. But at the end of the day, if you're a business owner and your business takes care of your family financially and your children's future and so forth, it's important to protect that at night through, the integrity of the building, hostile terminations and so forth, and that's where we step in. But if you're hiring a company that's paying the security guard to preserve the environment less than you pay your babysitter, that old adage of you get what you pay for is definitely applicable.
I certainly understand that. We charge very high prices because we deliver. And that's why you're on the program, is because you are at the top end of the security end.
Well, again, I'm flattered to be here. I am complimented, but it's not me. It's my team.
So tell us about some of the examples of things where you've been involved.
Numerous. So one of the higher issues, homelessness is a hot political climate right now. It's a talking point, and it helps with elections, and it helps with fundraising, and it helps with taxes. We have a scenario now that we're dealing with in the University of Washington district, where there's a high homeless population, and there's also very high rent for the students. Astronomical rent compared to when I went to college. And there's scenarios where the homeless we had one situation where the homeless were actually breaking into the building. It was an older style building from the 30s where it had a sitting parlor, an entry area, and they were shooting up heroin. And the ownership called us because they needed someone to be there constantly to deter the homeless. It was a very specific negotiation, but those homeless are no longer there anymore. Mm-hmm. I'm very empathetic to the homeless population, and when you talk to some of the people, they've had a bad run at life. But on the flip side of that coin, some of them choose that lifestyle, and usually the ones that are more combative or aggressive don't want to give up their lifestyle, and that's where we politely ask them to reestablish their lifestyle at a location that isn't interfering with graduate students or making people who pay astronomical rent feel unsafe in their own home and so forth. That's a pretty common client that we're having now. We deal with a grocery chain right now, where the shoplifting is epidemic. It's epidemic. And the customer service rules of the grocery store are to help every customer. And these people are literally coming in, shoplifting, and then returning the items without a receipt. We're putting a stop to that. So our goal is not a very good business model. Our goal is to put ourselves out of business with clients. We want to come in, solve the problem, and then move forward. But unfortunately, a lot of clients end up keeping us because they just see the change in the environment. They feel safer. And that bill that we send them does not become a burden as much as a budgetary issue. And we're very flattered by that.
As I think about what's happening in Seattle,
mm-hmm.
There's two trends that are going on we've never seen before, and that's that people are moving downtown. Millennials are moving downtown, and older people are moving downtown. That we have not seen before, but that means that when you have the homeless where we are, that's an issue on the streets. When you can't walk at night on the streets,
mm-hmm.
that's an issue.
Let me be clear. Sometimes we bring them both together, but there's the homeless that are drug users, and there's the homeless that are the non-drug users. And when you talk about being on the street and home, there's a two-prong issue there. The heroin epidemic here in the city is ridiculous, and unfortunately, it's through needles. And so when you just talk about the safety, this is the example I give people a lot of problems where I have some of the disconnect from the political climate of the city is, if you have a small child that likes to pick things up off the street and there's a heroin needle on the street, that's a bigger issue. It's one thing to have a homeless person that's asking for some money and some, trying to get by and food and so forth. And there's another individual that's just passed out there on your $1 million condo building with a needle in his arm. And I'm speaking from experience of observing this and trying to resolve the situation. America is a great place, and this city is very, very outstanding, and you can really turn your life around and be something. But your individual challenges really are not the responsibility of someone who's overcome their own. $1 million condos come with about an $8,000 a month mortgage, and if you're paying that on top of your HOA bills and you have a beautiful view of the city, the last thing you really want to do is come out of your building with those HOA dues and see a needle on the ground with possibly the individual attached to it. It's just not a safe environment. And I go back to that lifestyle of some of the homeless that do drugs. They're very combative.
They can be.
Yeah.
I spent a few years mentoring guys that were off the streets and out of drugs and out of prison just because I had a burden to do that.
Mm-hmm.
And as individuals, they seem to do well.
Mm-hmm.
But as a group, there tends to be a group mentality, which is negative.
It's like they say, people are smart, or a person is smart, but people are stupid. Unfortunately, that's not the best way to say it, but it seems applicable sometimes. It's really sad because we have a lot of opportunities to better ourselves, and drugs really hinder that sometimes, and you get caught in it. I've lost some friends to drugs, and it's very sad.
And anyway,
yeah,
you deal with a lot of special situations.
Yes.
If someone wanted to contact you, how would they do that?
If they want to contact us, the best way is literally Google Stephen Group International. That's STEPHEN Group International, and our Facebook page is going to pop up there. And you can submit a request. There's a contact number as well as an email right there. And that's for anyone also who's curious about being part of the team. You can submit a resume through the Facebook page right there.
Awesome. You do some great work. Thanks for being on.
Well, thank you very much. I'm flattered to be here. Thank you again.
We're coming to commercial break. Don't go away, because I want to talk about big ideas and our new Economic Council advisor. We'll be right back. Don't go away.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So this week we got to see or got to hear from the new economic advisor to the president, Larry Kudlow. Very, very well-known economist on CNBC. He's there every day. And so I was watching his outlook. He actually explained his big issues on CNBC. He's all in favor of a growth economy. That's great. A lot of people have done great things with growth economies and some not so good. He wants to lower taxes. He likes low taxes, and we're going to talk about that in a bit. And he wants a sound and steady dollar. Now, I happen to look at experts like Kudlow, like Kramer, like many of the newsletter writers, many of the people you see on TV. I like to look at them and see how well they did in their predictions, in what they thought. And Kudlow was an economist in the Reagan administration. He really glommed onto or grabbed onto supply-side economics. He was an advisor to George W. Bush, and he felt the supply side with substantial tax cuts would really grow the economy. He thought it was going to lead, the Bush tax cuts were going to lead to a big economic boom. He called it the Bush boom. And he was disappointed. Or it was disappointing when that didn't happen, especially when you compare that to the fact that Clinton raised taxes and got a Clinton boom. But Kudlow held firm to his predictions. Those tax cuts came in the early 2000s. But as those tax cuts came, Kudlow kept saying, it's just around the corner, it's just around the corner, it's just around the corner. We're going to see the Bush boom. You know, in December of 2007, he said, there's no recession. There's no recession. In fact, we're about to enter the 7th year of the Bush boom. The 7th year of the Bush boom. From 2007 and 2008, Kudlow didn't budge from his idea that the tax cuts were going to lead to a boom. You've listened to him on CNBC if you've watched CNBC. He focuses on a big idea, and there's no changing his mind. That's my take. You know, in fact, one of the most famous quotes from Kudlow, I'll never forget. He said, and this is in April of 2008. We're very close, coming up in September of 2008. Lehman Brothers will file for bankruptcy. Bear Stearns has already collapsed. We're watching the collapse of the financial system. And Kudlow says, we're in a mental recession. We're not in an actual recession. We're in a mental recession, and we've got just a lot of pessimists around. I thought that's a quote that I will remember almost forever when he said, "We're in a mental recession, not an actual recession." I have questions about that. And as we go forward through this economic time and through the rest of this Trump term, the question is, what kind of advice will he give to the president? And will he actually look at the data? Will he actually look at how the economy's doing and understand what the impact of the tariffs are, what the impact of the tax cuts are? You know, it was one big idea, and no matter what, he was going to stick to it. You know, Harry Truman said, "I would really like to have one-handed economist." Most economists will say, "This is my view." But on the other hand, Truman said, "I would like to have one-handed economists," so that they say, "This is the way it's going to be." You don't have to worry about that with Larry Kudlow. He's going to tell you what he thinks. And maybe everything's going to go well. You know, the fact is, the idea of tax cuts stimulating the economy goes back to Galbraith's numbers, or John Kenneth Galbraith, who predicted that when you made tax cuts, it would stimulate the economy. You know, very often, Kudlow will cite the Reagan tax cuts. The individual rates were cut from 70% at the high end to 50%. That's the tax cut we're talking about. We're not talking about cutting the rate from 40 to 28% or 30%. We're not talking about cutting corporate taxes from 35 to 25 or 21 or wherever we're going to end up. And we will have changes before it's all over with. You know, the Republicans used the fact that there were 14 million jobs created from 1981 to 1987, but 3.5 million of those took place before the tax cuts took effect. And when Reagan took office, we were in the midst of a recession. If you look at where we are now, we're not in a recession. We're in a very growth economy. When Reagan took office, unemployment in 1982 was 10.8%. Think about it. That's not far from the unemployment we saw in 2008. Conditions were very, very different. October of 2009, unemployment was 10.2, very close to what it was at the beginning of the Reagan administration. You know, so yes, we saw the tax cuts, we saw the economy take off, we saw people go back to work. We saw the same thing happen during the Obama administration when unemployment began to sink and the economy began to take off. You know, the tax cuts also, when Kennedy, you know, Kudlow talks about Kennedy tax cuts. But the tax rate when Kennedy was president, the top tax rate was 91%. That's how we got to 70. And under Reagan, it went from 70 to 50. And the biggest tax cuts came to the bottom of the scale. The average was only $100 per person. But by the time the butcher paid the baker, paid the candlestick maker, it had a significant increase. Today, that would be like a tax cut of $710 to the lowest paid people in the country. But that's not the way the tax cuts were put together by the Republican administration. These tax cuts were targeted 85% or 88% targeted to corporations and the top end. And I'm not saying there won't be a trickle down, and I'm not saying it's just because it was the Republican, because they also did something that will stimulate the economy by cutting individual tax rates at the low end. But those tax cuts go away. We are now talking, or at least President Trump talked this week, of doing tax cut number 2, which makes those tax cuts permanent. That gets us back more to the Reagan and the Kennedy tax cuts. But as we structured now, we have tax cuts, which I think will be very good for the stock market, very good for companies, less good for the individuals. But we'll see. I could be completely wrong. And we'll see how Kudlow does in this whole thing. I think he has big ideas. And I don't think his past has shown that he comes off those ideas very easily. It takes a lot to move him off those. It's a program today about big ideas. I think big ideas are good, but I think you have to be very sensitive to the warning signs. You have to be very sensitive to the fact that things may not work out the way you expect. And when you do, you have to make changes in what you do. That wraps up today's program. If you have any questions, if you didn't hear the whole program, go to Adams Financial Concepts on the website. They'll be posted there this coming week. You'll also find a blog with a number of additional comments and questions. You can actually log into that blog. So do that. Like us on Facebook, like us on Twitter. Sarah's been tweeting through the program. Add us to your Twitter as well. Anyway, that wraps us up. Have a very good rest of the weekend, and I will be back next Saturday.
Listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts. The following program is sponsored by Adams Financial Concepts.